Okay, let's get started. Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers to bring you this webinar today on Santa's secrets for option trading success. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. And just a few quick housekeeping matters before we start. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. If you have any questions at all during the presentation, please feel free to enter them into the Q&A box, and our speaker will be happy to answer those at the end of his presentation. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people how to trade them. And our parent company, Regal Securities, has been servicing investors since 1976. At eOption, we offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform, as well as free trading tools to help you spot option trading opportunities. And also, recording of this video will be available on eOption's YouTube channel in the next few days, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe to eOption's YouTube page today. And so before we start our presentation, I'd like to walk you through our disclaimer for a moment. Options trading does have risks. And if you want to take a quick look at what's on your screen, I want to bring your attention to the fourth bullet point. Options carry a high level of risk and are not suitable for all investors. And certain requirements must be met to trade options through Regal or any of our divisions, including eOption and InvestTrade. There is a booklet called Characteristics and Risks of Standardized Options. And if you reach out to our support team, we'd be happy to provide you a copy. But we encourage you to read it before you start trading or investing in options. So again, and this webinar is also for educational purposes and is not recommendations or personalized investment advice. So I'd like to turn our attention to our speaker now, Teddy Kestadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy is a professional trader and has over 30 years of trading experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked and is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University in Chicago. So without further ado, I'll turn it over to Teddy Kestadt. Thank you.
Thank you, Gina. I think everyone should be able to hear me now, and I'm sharing the video. You should be able to see me now. And let's see, I'm going to trying to get my screen up for you. Here we go. Zoom just gave me a little delay there. Okay, so now you should be looking at the eOption paper trading platform. This is the same as the regular platform, but obviously it's a demo account. So it's a very easy platform to use. Right here, we have the account summary tab here. There's a daily outlook tab where you can find information on obviously market movers and news of the day coming out before the markets open. There's a watch list here you can set up. There's a charting feature here, research feature, option chains to look up pricing and different variables for figuring out option trades. We have the trading tab, which we will be using, positions and orders. We will be using that tab as well. There's news and AI. There's a stock screener, options play. That's something you definitely can look into. This is a very good tool for both novice and experienced options traders to run scenarios and figure out different strategies and see how they would be working in the market. Obviously, there's an open account button there also too on the demo screen. So with that, we've covered the trading platform. Also, we are going to, you got to remember that today is Fed Day. So in the next 15 minutes or so, the markets may get haywire, but this is good because we want market action, especially because it'll help us with our webinar. So real quick, I'm going to pull up this chart here. You can see this is the E-mini futures. So showing you how the S&P 500 obviously has been in a rally trend right now for the past couple of weeks. Today, right now, I just looked at it before we started the webinar. It's basically flat, unchanged on the day, very atypical for a Fed day. So we're going to, we know that the market has been trending higher right now. Overall, the broad market is a bull. So this perspective will help us as we get through the different trades that we're going to look at. And today's webinar is also part 2 of a series on using decision trees for option trading strategies. Okay, so it's not a requirement that you watch the first part. This video will stand alone on its own. However, if you do want to go back and review it, I highly suggest it because the information there is very, very critical to understanding how decision trees work. And then you can see also how over time these positions, how they had worked over the past few weeks since we did the last webinar. Okay, so with that being said, real quickly, I'm going to give you a quick review of what decision trees actually do for us, okay? So decision trees are something that can be used for all kinds of different things out there. The main thing is that when you use a decision tree, you got to have a couple of variables. So it's basically like a simple algorithm. So one, we have the strategies. So we know that we have various option strategies that we can use. The question is, when do you use them? Decision trees help you with that because there's 2 other parts to the decision tree. So we have one is a strategy, 2 would be the technical situation, okay, which will help us dictate which strategy to use. And then there's a directional position that we have also as far as our analysis. Which way do we think the market is going or not going? These 3 things together will yield what we should do in any given situation, okay? So the strategies that we will be covering will be potentially getting long a call, all right? That would be the strategy. Directional position or bias would be when we are most bullish the market, okay? So the technical situation would be typically after a big pullback in the market when it's trending in a bullish trend. For instance, like we know the broad market is in a big bull trend right now. Obviously, we know volatility could come in today because of the Fed day, but as a whole, the market's trending higher. Typically, the broad market helps to lift equities. So that gives us a bullish slant potentially for the examples we look at. The strategy also that we may find is a put situation. That's when we are most bearish. So the strategy we put, the directional bias component would be when we are most bearish, okay, and that would be the opposite for the technical situation is for the call is when we have a situation where the market's trending lower, it has possibly had a correction to the upside. We're looking for another validation to go lower again, and that would be a situation where we would be long a put, okay? Then we have a situation where we have vertical credit spreads. That would be, once again, the strategy component. And then we also have our directional bias. It's when we have a clear bias as far as either the market is going to be staying in a range trade to higher or lower, okay, depending on whether we do a bull or a bear credit spread. And we're expecting this move to happen when it's very close to expiration. Now, we happen to be close to expiration, so we have some potential opportunities for some credit spreads in the examples ahead. And then we have also the technical situation there will be when we have a minor trend change, okay, is expected. And typically that would be in the opposite direction of whatever vertical spread we would do. Then we have another component that we might go over today in our examples is a straddle situation, okay? Now this is when we are looking for an immediate move and a large move far from the expiration date. Okay, so that means we have a potential to see a lot of market action when we put on a trade like that. Okay, so once again, the strategy for a straddle will be that, or excuse me, the strategy component is a straddle. The directional bias component would be an immediate move expected. Now with a straddle, it doesn't matter which way it moves. It just matters that it does move. Okay, now there's four different variables that can give us a technical situation for that situation. That would be the market's wedging. We're going to go over an example like that, or the market could be near a trend line. We're going to go over something like that potentially, or there's a cluster of closes. We definitely have an example of that. Okay. And then there's another component where open interest could be increasing dramatically. In other words, volume starts to really explode. And then one of the last things we may cover as far as strategies would be calendar spreads. And this would be where the directional bias is a sideways market near term, then resuming a trend. Okay, so and we'll go over if the situation arises, how to implement that one. And I believe we actually have one on there, or a situation for that. This is a situation too where you're expecting the trend to resume, but not right away. And you're basically you're selling time on that spread. Okay, so we've gone over the potential strategies. All of them are very basic strategies. Okay, and we've covered them in prior webinars. I encourage you to go and look at our the webinars we've done on the eOption YouTube channel on different topics that like on these individual types of strategies. And now, especially if you look at those, learn them better, and then watch these videos again, you'll really click on why these things, the decision tree especially helps. All right. So with that being said, we know that the market's trending higher. We're going to go to our positions and orders. So in our last video, we had put on positions in Walmart, Northern Trust, and the CME. Okay. Now for Walmart, we have this situation here. Now I put a line here. This was when our last webinar was. It was on November 21st. We used the 155. This green line is our base strike price. Okay. And for our position here, you can see that we have one December 29th put 155 strike price and one December 29th call 155 strike price. So when you have the same strike price, one call, one put, that is a straddle situation. Okay. Now at that point, we were looking for upwards of a $5 move. Okay. Ironically, 2 days ago, we had hit that mark at 150. Okay. So let's look at this position right now. So this trade, when we had put it on, if you're looking at want to see where the prices are right now, it is pretty much at just a slight little loss because the market is actually back where it was. All right, excuse me. No, I'm sorry. This one isn't a loss. My bad. This one here, we had the opening price on the put was 185. Now it's trading at 310. So that's up right there, $2.25 or $225. And then we had this other one where it's 385. So then this was at $3. So yeah, we're right at just a small loss. Now that right there is because if you look at the distance, we put this trade on when the market was trading at 155. It's $3 lower. 2 days ago, this was a profitable trade because we had hit that $5 mark. Now we're coming close. Time decay is no longer really an issue anymore because we are now 2 weeks out from expiration. So the difference in pricing for that for the last 2 days isn't very much. Now this one here, you can see is only down, what is it? It's down about $20. Let's see, I think that was 380. So that's $3 plus 280, that was 20 cents. So that's $20 on the position altogether. Now, had we executed out of this trade and we gotten out of the straddle 2 days ago, especially when it was around 150, that would definitely be an up position there. It wouldn't be very much, but that's because we've had a whole month of time decay also. Had this move here happen, especially like a week earlier, this low right here, that was more like when this low happened here, then the position probably would have been up around $100. Time decay and movement are things you have to take into account with a straddle. So you want the movement to happen, but the longer it takes, it erodes that position, okay? Because you lose time value on both the call and the put. When you're making money on the straddle, once again, you don't care about direction. We just care about movement. So in this case, it's the put that gain value, and the call, obviously, because the market's below the strike price, loses value. So what the question is now, what do we do with this situation? Well, we know that we still have 2 weeks to expiration. We have December 29th. So we're going to put this right here. We're going to use our decision tree to figure out whether we should exit this position, maintain the position, or possibly even add to this position. So that's the beautiful thing about decision trees, is that you can manage your positions. For instance, like in this case, where 2 days ago would have been, because our objective from the webinar prior was that once you hit a $5 move, check out the pricing. And if it's if it's very far away from expiration, especially, get out of it. If it's really close to expiration, then we have to dictate whether we scratch the trade or if there's still a potential for more market movement. So we know that the $5 was already hit. Now, the good thing is that in this situation, we know that Walmart had this big gap down. We know that they're looking at already downgrading earnings for next year. Now we have the Christmas season. Obviously, there's going to be a boost to fourth quarter. However, the projected earnings for Walmart are not looking good for the year ahead. So the trend, besides this gap here, has been going lower. Is it going to continue? It may not. So the question is what do we do with this? So we go back to our decision tree. So we know that typically with a straddle, you're looking for an immediate move. Well, it's now 116, and we can see that the market is definitely rallying here right now. So who knows what the Fed announcement did? If the S&Ps in the broad market it's rallying, it could be just a moment. And as we're talking, yeah, it's ticking higher. Okay, so what does that mean? Well, we're getting back to our baseline. So that position right now, the question is do we expect it to go higher or do we expect it to go lower? Well, the trend, no matter what, is lower, since we are in a position where if it goes back to the 55 mark, okay, let's see what happens here. So the trend is on a very steep slope right here. And as you can see today, actually, it's breaking out of it. So if it gets back above this upward sloping longer term trend line here, that would be a very good indication that this 155 mark, we're not only going to hit it, but we're probably going to springboard back above it. Okay. Doesn't mean it's going to happen. Not necessarily. However, we do know that the range for Walmart pretty much has been gravitating up towards this 160 level. So from 152 to 160, that would put us $5 away from our original point, and it's a $7 move from where we are now, or almost a $7 move. If that happens, that $5 will put us in the money once again. And if it goes even higher, it goes up to 165, we'll really be able to capitalize on it still. Okay. Now, because remember, if this would have happened 2 weeks ago, you would have wanted to have gotten out because of the time value. Time value is already gone. So we could initiate a new straddle right now, but we wouldn't be doing it for the December expiration. If we wanted to initiate a new one, then we would go for the January expiration. Okay. So now let's use our decision tree once again. Are we most bullish, meaning we would buy a call? No, it's good because it's a trend, because we know the overall market's going up, but this one's trending lower. Fundamentally, there's a lot of bearish overtones for this. Today, this rally right now that's going on in Walmart could be just our knee-jerk reaction to what's going on with the Fed. And that's another thing that helps us out too, is that we're only $2 away from that 150 level. We go back to that 150 level, we should be back in the positive territory on the trade. Not very much, because we've lost all the time, but anything beyond 150, which would be going with the trend, would actually boost us. So then we can turn that trade into a positive. So once again, we go back to our eOption thing. So for Walmart, for the straddle, we're going to leave that on. But not only are we going to leave that on, we're going to put on a new one. So right now the market's trading at 152.50 basically. So let's see if we can find for Walmart, WMT, we're going to put on two options. We're going to do a buy to open on both of them. Remember, when you're buying a straddle, you're buying a put and a call, one of each. So quantity is one. Expiration, we're going to go out to the January 26th. So that's a little over a month and a half. Okay. And then the strike price, what we're looking at, we're trading at 152. So let's see what we've got here. We've got 155. We've got 150. So if we want to put on another trade, well, we wouldn't put on the 155 because we already have that one on. So what we could do, though, is use this baseline here of 150, because we're looking, if this market is true, if the Walmart stock is really going to be in a bear trend, if it takes out the 50, it's very likely that it's going to take new lows down at least another $2 to $5, because that's what it seems to be doing every time it makes a swing low. that potentially gets us from 150 down to 147.50, 145. Okay, so that would be stretching the downward trend. But let's say that Walmart all of a sudden gets a lift from the broad market. Okay, well, we know that that will help our old straddle. And then if we buy the 150, we're already $2 into the move. Now, that means that on the call side, it's going to be very rich. Then if we get a rally up towards, say, the 157 to 160, which is a $7 move, which we're definitely looking for right now, just to go back into that range, then we're looking at being able to capitalize on the new straddle. So let's put this one on. Let's see where it's at. We're going to go with the 150 strike price. Okay. So right now, 150, and we're going to do one call, one put. All right. So once again, we're buying to open both positions, quantity of one of each, same expiration, same strike price, one call, one put. And right now we're going to verify the trade that's lined up. It's going to cost $717. This is after the fees here. Remember, with eOption.com, you only pay 10 cents per options contract, very low pricing for options in the industry. And there you go. That's how we do the same thing on a regular trading platform. Now we go to our orders and positions. You can see that we have the Walmart now January 26th. We have the 150 put and the 150 call. It tells us the market value, where we're at, and now we have added that to our position. Okay, so let's mark the chart here, just so you are aware of where we're at again. So the second one here, we're going to make this number clear for you. 150. Ah, got to get this cord out of the way. Thumbs today. Sorry about that, folks. Okay, so 150. So here's our new strike level here for our new straddle. So now we have two straddles, one going into expiration in 2 weeks, one that we have all the way until January. Now, interestingly enough, is that if we go on the weekly, look at this. On the weekly trend, that was that longer blue line. Last week, we had fallen below this trend line, obviously settled below it. Today, we're now trying to push back up there. But look at this slope from that gap down. That's a big correction right there. Overall, this market's in a bull market if you look at it on the weekly trend. So the weekly trend actually is in line with the current market trend, which is in a current rally right now for the broad market. So that may mean that the bullish side of this trade, we may be nearing the bottom of this swing low here for this week. We may have already planted it and get a nice Christmas rally. Remember, also, there's a lot of window dressing that comes on at the end of the year, where up until now, into this point of the month, anyone that was up on a lot of things, they've taken profits on certain things because they want to kind of lock in their return, their numbers for the year, because their balance sheets are closing soon. They want to have those, be able to say, hey, as of January 1, 2024, we had this return for 2023. So a lot of that's going on. There's also, you have year-end buying too, because between now and the end of January is when most people are adding to their profit sharing plans, to their SEP IRAs, their Roth IRAs, and what have you. So there's a lot of money that people are to defer taxes will be putting into the market. So, and especially now that there's the theory that yields are going to start to go down again, instead of keeping money in cash or into CDs or whatever, which have finally become attractive again, they're probably going to be putting money into, like, say, stocks, whatever it is. Is it going to necessarily be Walmart? I can't tell you that one for sure, but it is in that situation. So the bullish situation here is good, but not enough, once again, to give us the call, because the decision tree, remember, is where this would fit a call in the sense that it's after a pullback. The only problem is the long-term trend on a daily is really sideways for this to lower. Okay, so that would be a counter trend. So we don't want to take a call, but the straddle removes that. So then if it's a bull and we get the bullish rally, good for us. And if we don't, if let's say, especially like it's Fed day today after reaction, what happens if all of a sudden the Dow and the S&P is tank over the next couple of days? Well, that reinforces our original straddle position from Walmart. And then it also gives us a little heads up lead on a new move low, which would help us in the direction of the new straddle position. And it also puts us in another position, not to use that word so overly done there, but where you can make the decision to take off that first straddle. Remember, time value is already gone, but if we get down to say 148, 145 in the next week or so, why wait another week or so for expiration on that straddle? So then you can cancel the one straddle, take out of that one, and ride the other one. All right, so we went over that example. Now let's take a look at Northern Trust real quick. Northern Trust is a great bank stock. Bank stocks have been getting beaten up for a very long time because of the yield curve. Notice that this market bottom, Northern Trust bottomed the end of October. That's when the yield curve also started to change. That was when we had hit the highs in yields, and now we've had a retraction, meaning that yields are going down, bond prices are going back up. Okay, there's an inverse relationship. What has this done for the banks? Well, the banks were getting squeezed because as yields were going higher, they were writing less and less loans. People had gotten used to paying next to nothing for interest. Now, all of a sudden, mortgages are going off at 5-6%. Okay. So, but now over the past month and a half, things have come back a little bit by the market rates. And also, it looks like the Fed is going to remain kind of neutral. So, bank stocks, which have been beaten up now, before, like when we did this example from the last video, this is where the market was coming to the point where we didn't know, was it breaking out right here? Or was this just a correction? And that's why we had put on this trade here, which we have a 75 put, 75 call expiring soon. Okay, now on this one, we had gotten in, the call was at 770, now it's at 630. So that one's down $1 a little $1.37. And then we have the put, the call, I'm sorry, that was the put, and the call, however, is at 910. Was where we got into it, and now it's worth $12.50. So that one there is worth $3, over $3 more. So this is a nice position that is in the black. Okay, you can see that we put the position on. It was a 75 strike price straddle. Now we had gotten above 82.50 a few days ago, and now we're at the 81.25 level. So here's the question: what do? We had gotten the $5 move. Okay, so should we exit this position right here? Well, this one's a profitable position, and we hit our target. What is one of the key things to trading? Money management, sticking to our plan. We had a plan of hitting $5 2 days, a week ago. We could have gotten out with it. Now we're together. Now we're going to do the right thing, because that was just sitting there. I haven't looked at this since we did this a month ago. So what we're going to do right here is we're going to jump on the platform here for this $75 put and call. We're going to put a little dot here on select and a select right there. Okay. And then close selected. Boom, we get a validation for a new order to close, sell to close, because remember, we bought to open. It reconfirms what we're doing. We're the 75 strike price, put call, verify. Here's our total proceeds of $1,805. All right, boom, we executed the trade. And why did we do it? We used the decision trade to put the trade on in the last webinar. And now we hit our $5 price point. We know there's no more time value left. And it could go higher, but it may not go higher. Okay, it doesn't matter. We hit our target. Now, had we been watching this webinar was last week and it was spiking at 82.50, we would not only have a little bit of time value in there, we'd also have a little bit more value on that straddle. Now we're still, the market's moving higher, move highs, and we're just below the highs. Let's see, what do we do now? Let's look at our decision tree. Okay, well, we know that we have an indicator here that's starting to say that the market's overbought. We have our super trend indicator, that's this red or green, depending on which way the market says buy or sell. This has it still in a buy mode. Okay, we know that we broke out to the upside, but this trend is pretty steep. Now, the good thing is that we just had the last Fed meeting of the year. Could yields go higher? Absolutely, anything can happen. Could they go lower? Possibly, that's the consensus. But I would say with the holiday trade and whatever, we're probably going to be set more for a range trade, and the yields probably won't be really pressing things. So the question is if you look at Northern Trust and we go to like the weekly basis, once again, this has been in a downtrending market. However, this is a big breakout over since we did our put on our straddle. This was still in a bear market with a sells thing. On the monthly basis, the oscillators here is now oversold. with a buy signal, and we have a buy signal in the super trend. So with this, Northern Trust seems to be still in a bullish case scenario. Now, the market hasn't dipped. So the question is, are we extremely bullish? That's when we would buy a call. Well, we're bullish, but we've already had, we know that this was originally viewed as a correction. Now it may be the beginning of a change in trend. Okay, but we haven't had any confirmation of that yet. That takes a little bit while yet. So what will we do? Well, we're bullish, but we still know that there's a possibility of some sideways to lower trading. So buying a call probably is not the right thing to do, right? Of course not, because it says in a technical situation, you put on a call after a pullback in the major trend direction. So we haven't had a pullback. Okay, so the decision tree right here says don't get long the call. All right. What about for a credit spread? Do we have a directional bias? We do. Are we close to expiration? We are. We could do one for the next 2 weeks. However, we're heading into holiday trade out. If it wasn't December and end of year and holiday time, then I would say that might be a good situation. But because the fundamentals there, they really change that situation, because our directional bias is murky. So since we don't have a solid directional bias, the vertical credit spread doesn't work in this situation. Okay. Straddles, calendar spreads. Well, straddles. Okay. Well, let's see. Let's just say that Northern Trust, this was maybe still is being viewed as a correction before we can confirm things. Well, if we use the old Fibonacci technique here, and we look at the 50% level right here, this is always a good buying area, somewhere between 50% and 0.618. But then we'll also throw in the 0.382 level just to see where we're looking at. So let's clean up this chart real quick. All right, so what did Teddy just do here? All right, so we know that we have a nice upward sloping trend here. We're riding it. Remember, there was the one thing what was the, if you are touching a trend line, technical situation, once again, gets back to our decision tree. Immediate move expected. We're definitely not expecting this market to stay in a range trade, because it's broken out to the upside on the monthly basis. It's pressing a corrective trend on the daily basis. Is it turning? Who knows? Odds are it may have, if it does have a sell-off, that will be just setting us up for another buying area before the trend resumes. Remember, because right now we're not trying to pick a bottom or a top, never try and do that, but the situation is lining up for that. So we have touching a trend line, we have immediate move is expected, straddle. We don't care if it goes up and down. So this is not all about straddles, but right now this happens to be the situation. So Northern Trust, we know that we have this here, the 75 put, the 75 call. Okay. And we go to the trading thing here. So we know there was the buy to open right here. It was Walmart. So we're going to go now to NTRS. Okay. And let's just see. We have the market's trading at 81.24. So the first thing we do is we go back to our positions and orders. We know that this one here, we had already gotten out of that. So even though this is still in the order bank because it was from today, but it's closed out. Okay. So now we're going to make the new one. So we're trading at 81.25. Let's see what kind of options we have available to us. So we go once again with the buy to open, because we're opening the spread. We have quantity of 1 at each. We're going to go to January, and we're going to go look at the strike price of, let's see, what is it going to, we have 81.25. Let's see if we can find an 82.50 and $80, see what it's at. We have 82.50. So 82.50, it's 81.22. It's $1.20. It's basically, it's right in the middle of 82.50 and $80. So since we are in a bull trend, okay, I'm going to leave it at the $80. Okay. So remember, when you're doing a straddle, that your strike price has to be also the same price. Now we put one call, we put one put, it gives us our pricing here. We have a debit of $5.95. So we're going to put this one on. the eOption screen puts out. It tells you your commission cost. Remember, it's only a dime per transaction for options. 604, we hit the trade button. It's verified. It's all good. Now we go to positions and orders. Now you can see we have 2 positions here from Northern Trust. The one is closed out. Okay. And then we have the new one that is put in. So now we have that right there. You can also see from your, well, the account summary, you can see how the balance is changing. Unrealized P&L, we just put on some new positions. So that's changing there as well. And now let's go back to positions and orders. So we have done the Northern Trust. We'll put this at $80. There we go. And this is the new strike price. So we hit the $5 target. We got out of the old straddle. Then we went back to our decision tree. So you don't have to think when you have a decision tree. You know, it makes options trading, I wouldn't say easy, but definitely easier. Because why did we put on a straddle? Well, let's see. As far as directional position bias, immediate move expected, it fits that category. Then we go to the technical situation where it is touching a trend line. The market's not wedging. There's not a cluster of closes. And as far as open interest, it doesn't matter because we already have the other variable. So straddle is our call for Northern Trust. So if anybody, just out of curiosity, I have the one Q&A up. I don't know if I have the other one up. Okay, so no questions so far. I don't see anything there in the Q&A. Okay, all right, so we're going to keep on going. So we're going to go to our next one, which, let's see, is the CME. So we're going to go to the CME tab, and then we're going to get into some newer ones. So, all right, so CME, we had 2 strike prices that we were using in the last video. So we have positions and orders here. We have this here, which is the 215 put and call from December 29th. So we have 215 was where the market was at. Now you can see that the market pretty much is right where it was when we did this webinar last time. So no matter what strategy we would put on, we know it's basically all that's happened is time decay. All right. We didn't have any market move, but let's see what we did. We had a straddle on at the time, 215 put, 215 call, same expiration. We know that it expires in 2 weeks. Okay. So the expiration part, time decay is gone. We did get the $5 move that we were looking for. It happened here. Of course, I didn't get out of it. I didn't even pay attention to it because it's from the last webinar. But let's take a look at where we're at. So on a weekly basis, market's obviously trending higher. It's starting to go sideways. It looks like it's overbought according to this indicator here. Super trend still has it in an uptrend. We are coming close to the trend line. What does that sound like? The other example that we just had, right? So on a daily basis, what do we do with this trade? Well, if we look at this, we entered, the put was at 640. Now it's at 760. So that right now is up $1.20. Then we have the 490 for the call. That was at 225 before. Okay. So that right there is, so we lost, we're on the put, we're down, what is it, $1.20, but on the call, we are up money. Okay, so on this one, I'm sorry, no, on this one, we're down, excuse me, we're down to 65. So 265 and 120, that's 385. So $385 is what we're down on the spread. Okay, so there's not much left in this trade. So let's take a look at, so it's the CME. We got the 215 put and call for December. Let's see what that's going off at. So we look at the CME. We're going to look at the pricing to see if it's worth getting out of this trade and scratching or possibly putting on a new trade. So we're going to add to options. This would be a sell to close. Sell to close. Expiration would be January 29th. Strike price is, what was that again? That was a 215, I believe. Positions, that is 215, correct. Always want to make sure that before you pull the trigger, that it's like the whole measure twice, cut once technique for when you're doing any type of construction or building to keep yourself from your cost downs and your mistakes from flaring up. Okay, so right now, Should we do this one? And we're just going to go to a verify this one. If we were to sell this, we would get $624 back. So we're going to cancel this one. Okay. Question is what's going to go on with this market? Well, we know that we had just touched the trend line a week ago. This strike price is right around the middle of where the market's been trading. So let's see. Cluster of closes. We have a cluster of closes that's been going on that led us up to this initial straddle trade, and it's continuing on right now. What does that sound like? Potentially put on a straddle trade, right? Okay. Also, market touching a trend line. It just did. So 2 factors for the technical situation. Is an immediate move expected? Well, this market's been wedging and going kind of now. This one did make a higher move high the other day and made a higher move low. So even though it's going sideways, it is slightly trending higher. So we're looking for definitely some sort of a move to break out, at least away from the 215 mark, and go either take this low out here to go $5 lower or $5 higher back like this. And especially if we do go to the upside, odds are, since we've been making higher move highs, higher move lows, if the trend is your friend and remains, we have a good shot at taking out this high, which was at 223, maybe pushing 225. That's a $10 move. Okay. So the question is do we put on new ones? Do we keep the old ones? And I would say that we're going to change this to buy to open. We're going to change December to January and see what's going on here for January 26th. Okay. And we're going to see the same strike price, which is right at the 215 mark. Oops. Almost there. Okay. And there. Call and put. So let's say we wanted to put on this because we think we need more time. Okay. Remember, we usually are looking for an immediate move. Well, we only have 2 weeks left on the original straddle. Let's see what this would cost. So this one here would cost $12.10. So it's $1,210. Okay. If we put that on the January one, that gives us the time going all the way out to January 26th, which will put us all the way out here. Okay. But what do we do with the old one? Do we get out of the old one, take the loss and put on a new one? Well, that one, the time is already eroded. We would be gaining an extra 4 weeks by putting on the new straddle. Okay. But for what it costs and the fact that we already have one that's on at the same price, because what strike price will we be using? We would still be using the 215 strike price. So we would be in effect rotating the spread buys us time, but that means you're chasing the trade. So the way I see it is we've already seen that in any given week or so, you're going to have a fluctuation of at least $5. Well, $5 to the downside from where we're at right now, 212 puts us down to 207. 207 would be new move lows, taking out this trend line. That would be 207 then would be $8 away from our initial strike price, which means that our spread that we already have on would grow in value. Okay. Remember, time's out of the equation, but the distance factor becomes profitable. Okay. Now, could it do that? Well, absolutely could do it. Let's just see if we had a retracement. Okay. We already bounced off the 50. Here's the trend line where it held, just it barely poked through it and held above it. We also had the 50% from this last major swing low to this recent swing high up here. What does that mean? Well, if it's a buying area, if this trend's going to hold right here, it shouldn't get below this 210 mark. What did I say? If it gets below 210, it has a good chance of getting down to 207. Well, 203 would be a really extended fib move. Okay. We're looking for it to get just down to 207. That's just a little bit below 210. It's $3 right there. Okay. That move is very rational as far as just on a corrective basis. That also means, let's say it stays in a range trade. So hitting that level is very likely. You can see on the day the market's turned around. The CME is down right now. Obviously, the market's starting to Fed meeting was half an hour ago. There's usually knee-jerk reactions, probably rallied first, and now it's coming down. We'll see by our other example. But if it also takes out the high from a couple of days ago at 216, it's got a good chance of going back up to 220. So that's $5 away from our strike price, where we can either exit at a slight profit or pretty much scratch the trade. Or if it makes a new high, let's say it just gets up to where it was here the other day, 223. Let's say it hits the 223 and takes it out by $1. That's just below 225. You're almost $10 away. So what we do with this one is that, remember, we have this position here on the CME. We're going to leave it alone. We're not going to put on a new one. We're going to leave it alone and give it a chance to become profitable over the next week. So now we've gone over 3 trades that we had prior. We had the Walmart, where we had changed. You can see this one is starting to come back too. We have the Northern Trust, where we had exited our original position and we put on a new one, remember, using our decision tree variables. Okay. And then once again, we have the CME, which we just did. All right. So now let's try something new. We have 15 minutes left. I have a couple examples here that we can fly through. Let's see. Why are there 2 calls in the CME? Oh, okay. That's a really good question. Okay. So yes, you did notice that. When we did this example for the CME originally, let's go back to CME from our prior video, and that's great. We have someone who's not just paying attention, they're really, really paying attention. When we did the original example, we were also very bullish, looking for a breakout. So when we, according to our decision tree, we had not just a straddle position on, we also put on another call, so just a straight call position. So that's one too, where we are just below there right now. We have the 215 call. Okay. Now we could get out of it. All right, but we only have 2 weeks left to the expiration. So, and also if you look at the value right now, the value is 225. Okay, that's where it's last. That's where the bid is, you know, or excuse me, the offer is. So the bid is going to be lower. And I'll check that real quick. This is really a good example of why you pay attention to what you're doing out here. So 215 call, we're going to go to January 29th. Okay, strike price of 215 call. Okay, so if we were to sell it, we'd only get $150. So could you take the 150 and, you know, get something back for your trade? Obviously, you paid almost $500 for it, getting 150 back. You're only down 350 on that call. Okay. But once again, we are still more bullish than bearish right now. Now, would we get into the call situation? That's when, remember, a call, the directional position is when you're very bullish. Are we very bullish like we were originally back here? No, here's when the market was wedging and the market was oversold. We were looking for a breakout to the upside. Indicators now are very mixed. This is the MACD here is kind of snaking along. Yeah, not necessarily overbought, oversold. You can tell it's in range bound conditions. So that's kind of a moot indicator. The super trend here, even though it's in a sell mode, it's also very sideways. So for this call right here, especially since we have the overall trend here on the weekly, where you can see it's higher. Okay. 2 weeks going, I would say hang on to that call. If now we would not initiate a call, but since we've already lost most of the value of it for that 2 weeks, I think you have a good shot at still hitting. And here's the thing about it too, is so we paid, what was the price we paid for it? We paid $490. So $490 right now, it's worth $2.25. So it's worth $2.25 at 212. If we get back to 215, okay, that's another $200 right there. So now you're looking at value of $350. So you have more of a chance over the next 2 weeks to recoup some of the, remember, the time value is gone on these options because they expire in 2 weeks. But we have a neutral to higher bias still. And since you're already long the call, it's not as bullish as it was before, but we have a good chance of getting above 215, maybe not necessarily getting up to 220 and breaking out to the upside. But if we can just get back to the middle of the range, you have a chance of recouping at least almost 50% of what you've lost so far. And then you have the option of changing, getting out of the position, and then you don't have to take as big of a hit. So that's something that you would have to make as a decision on your own, depending on whether it would be, say, over the next 2 days or next week. You know, like, remember, because of the way the holidays are going on the 29th, option expiration that in 2 weeks, you have Christmas Day off. You have that Monday that's going to be Christmas Day is going to be closed. So the market trading days that you have remaining are the rest of this week. You have 5 days next week, but then the following week you only have 4. Okay, so remember that. So your opportunity, I would say, that is probably not necessarily going to happen over today or tomorrow. Obviously, right now we're hanging on near the lows after the Fed release. The market closes in another hour and 10 minutes. So today is probably much done. We'll see what happens over the next couple of days. I would say you give this trade until sometime next week, and especially if it gets above 215 or even gets up remotely to say 216, 217, that's near the upper part of the range. You could scratch the trade there. If it goes, think about this. If it's at 225 now and you rally $4, wait a minute, 225, that's 625, you'll be able to scratch the trade or maybe even make a couple dollars on it. So I would give that. That's a great question. Great for pointing that out. So, and once again, we use a decision tree to figure out what to do with that position. Okay, so now I want to get into some other new ones real quick. So let's see, we have a stock AKAM. I'm going to look at this one right here. Okay, and see what we got going on here. All right, so AKAM, this is a stock that I was looking at for the last webinar, but we didn't get to. Today, you can see it's obviously breaking out to the upside on its highs. The MACD indicator had been overbought and then crossed. Now it's looking to cross back like it wants to break out to the upside for another extended leg higher potentially. Let's look at the weekly real quick. Weekly, you can see that this market is definitely in a bull trend. So the long side is definitely where we're looking to. And could it go higher? Absolutely. Is it a situation where we're very, very bullish? Well, we're buying into highs. So let's go back to our decision tree. Okay. Immediate move expected. Well, it's moving right now. So the question is the trend going to remain, or could we get a pullback? We could very easily get a pullback, have a little profit taking on this rally, and it would still be a bullish market. Would we put on a credit spread in this? Well, if we were just looking to do something over the next 2 weeks, then we would look at a vertical credit spread. And that is something where we would look to put on puts, where we would sell a put, say, below this swing low right here, and then one below that. So let's look at where this low is here. Let's see if a credit spread would be worth it. Well, here's the question, though. We just bounced off a trend line here. We didn't bounce out. We set this new trend line here. If we fail here from this previous low from the other day, that would set off a nice correction. Also, we got this level here, this 112, this is rising here. Once the market, if it does fall below here, that would turn the super trend buy mode into sell mode short term, as well as probably flip the MACD. We could be due for a correction as it stands. So let's just see real quick what kind of potential correction we could have before we jump on the bear. You got to look at both sides of the market to figure out what's going on. All right. So we go back to our good old 50% and 0.618 on the old Fibos here. So here was our previous higher swing low. We now are currently making a higher move high. So the trend is completely confirmed. There is no doubt in what is going on right here. So are we super bullish? No, we're definitely not super bearish. So the put's out of the question. Vertical credit spread? Possibly. Now remember, that's for close to expiration. So let's do this. We're going to put a little thing here. December 29th is the next expiration. And I think, what is it? January 26th, I believe, is the next one. Okay, so decision tree bias, a vertical credit spread, we would not buy out to January. Okay, so what would we do? We could look at the January 29th. So let's take a look at markets trading at 117. We have this 113. 92. So let's see if there's a 114 strike price for AKAM. All right. AKAM. All right. And let's see here. We have a, whoops. So then we got that set. So AKM, we want to have a 114 strike price. let's see what's going on with that. So let's go a buy to open, or excuse me, a sell to open, and then a buy to open. So this would be January or December 29th. And once again, we are here at the, what is it, the 114 we're looking for. So there is no 114. There's a 115, but that the market is, oh, so that, but that puts it up right around, it's right here in the middle of this top range. So 115, I don't like that because it's very easy to come right on this trend line here. Let's see what we have. So we have 115, 110. Let's see what the 110. Oh, wait, actually, you know what? We could do the 115 for the right and the 110. Let's see what this pricing is. Put. Okay, yeah, there's not much there. Okay, so on this one, there's, if we go for the 115 and the 110, that would be, you can see the market's at 117. We would be selling a 115 put and buying the 110. The only problem is for the risk reward, there's just nothing left in that trade for December. We could show you what it would go out to January and see. Here's the problem with that one. And you'll see by this example now. All right. So with this one, if we were to sell this right now, we would end up with a net credit of $130 to $140. That's for a month and a half of time. Okay. 140 on that credit. The only thing is, oops, this is 115. I'm sorry, you got to be wrong strike price, 110. That's not right. Okay. I'm sorry, a credit of 220. All right. So that would mean that there's a $5 difference between the puts. We would take a 220 credit right now if we were to sell this credit spread. The only problem is that we're not close to expiration. We're 6 weeks away. Now the risk on this trade right now, it's down to 2, would be basically you have $500 between 110 and 115. If you take in a $200 credit, you have $300 of risk. Let's go back to our example here. Are we very, very, very bullish? Not really, because we could see a nice correction back down towards this area and still remain bullish. That would trash that spread. We would lose $300 on that, on a pullback below this 113, especially if it comes down through here back to 110. We're looking at 109 is where this market could retrace back to, just on a profit-taking correction. So the vertical credit spread, because the only one that has any VIG in it for us to take in some money, is too far out. By the decision tree, we don't do it. Once again, decision tree helps us out. Okay, so we have 3 minutes left. I'm going to walk through one more thing here with this example. So we know that with ACAM, the vertical credit spread is not good. The long call is not necessarily so good. So why don't we go back to the 115 and we'll do buy to open and see what a straddle looks like. Now remember, with this one, we go out to January. This is a pretty expensive straddle here. So let's see, buy to open is right. January 25th is right. 115 call and a put. 24, this is a $2,400 spread. Okay, here's the problem I have with that. You have 6 weeks. Okay, in 6 weeks, for that straddle to be good, it has to be for sure by expiration at this point $24 away to make a break even. So the volatility on this one is just way, way too high. It's way too rich. And the distance here for the short term wouldn't take one with the expiration doesn't fit here for the straddle. So you see, it's not all about taking a straddle on every single trade. We can't do the short one because the timing isn't right and it's too far out and not enough of a credit for the other one. So on that, we've seen examples that we had used in the prior webinar. We came up with a new one. Here you can see how these things we applied them on adjusting trades and putting on new trades. Hope you all have learned something new here. Remember, you can watch these videos on the YouTube channel for eOption. I hope you check those out, the prior ones, and this one will be posted also. And want to say thank you very much once again from, oops, I got the wrong slide up there. Sorry. Get the right slide up here for Gina. I'm going to turn it over to her right now. You guys have a happy holidays. Thank you very much for everything. See you next year.
Okay, great. Thank you so much, Teddy. We really appreciate it. And it was very interesting and informative, and we all learned a lot. We'll definitely be using the strategy decision tree when I do my option trading now. So thank you to everyone for attending the webinar today. And just a few reminders before we go. First of all, if you are interested in giving our eOption trading platform a try, we do offer a free paper trading account, and that's what Teddy used in the webinar today. So you can go in and try your option strategies risk-free. We give you 100,000 in virtual money that you can play around with. And if you just go to eoption.com, you'll see a big blue demo account button. And if you click on that, it takes about a minute to open an account. You can get started and try practicing your trades today. We do also offer some great resources. I just want to point out, we do offer free trading tools. We do have a tool called Options Play that's normally $500 annually, but we give it to all our customers for free, and there's no minimum to open an account in eOption. And basically what that does is that scans thousands of stocks every day and highlights option trade opportunities for you. And we have people who are beginning option traders use it, as well as very experienced doing it for years using it as well. So it's a wonderful tool no matter what level you're at. We encourage you to go to our website and check it out, because it will help you set up your trades and find some great trading opportunities. And then if you also go to eoption.com, we do have a lot of great resources on our website. We have a page with all kinds of option strategy links you click on the link. Let's say there was something in this webinar today you wanted to find out more about, like a straddle or one of the technique strategies that Teddy talked about. You just click on it and it'll tell you what it is, when to use it. A lot of them have videos on it, and it'll just give you some more insight on option trading. We can't stress enough, it's just really important that options aren't as intuitive as stocks, so you have to really study and know what you're getting into. And so we do offer a lot of great resources. And you do see, we do, as Teddy mentioned, we have lots of videos on our YouTube channel. So if you subscribe at youtube.com/eoption, you won't miss any of our videos. And so we do have experts and professional traders do videos for us all the time. So we encourage you to definitely subscribe and be notified when a new video comes in. It's a great resource. And then in our YouTube channel, if you go in, once we post this video, you will see a promotion for some free stock if you open a new account. And that's usually for a limited time, for a week or so. So we encourage you to go in the next day or so and check in the video and check out that link if you'd like some free stock. So with that, we'll close it out. Thank you for your time. We were happy to bring you a lot of webinars this year. And please check with us in January. We'll have a whole new calendar of trading videos for the year. And also Teddy will be doing some of them as well. So he's a very popular speaker, and we thank him for all his work this year. So thank you to all of you for attending. Happy holidays and Happy New Year, and we'll see you next year. Thank you. Bye now.